Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to Personal Finance for Long-Term Investors, episode 130. My name is Jesse Kramer. By day, I work at a fiduciary wealth management firm helping clients nationwide. You can learn more at bestinterest.blog/work. The link is in the show notes. By night, I write the Best Interest blog and I host this podcast. I also put out a weekly email newsletter, and all of those projects help busy professionals and help retirees avoid mistakes and grow their wealth by simplifying their investing, taxes, and their retirement planning. Later on in today's episode, Cullen Roche will be joining me. Cullen is a plain-spoken, systems-oriented financial thinker, and I'd say he focuses on how money actually works rather than how people wish it worked. Unlike many, maybe macroeconomic commentators, though, Cullen's lens is very much grounded in portfolio management and real-world investing that applies to individual investors like us. He's concerned with how narratives about money can mislead investors into bad decisions, and I'm excited to share some of his latest thoughts with you all today. But first, we'll do a quick review of the week. This one comes from BAB3546, who says, "Excellent financial guidance, relevant and transparent. This is the only financial podcast I listen to. Jesse is great at explaining difficult financial topics, and his guidance aligns with what I believe helps the majority of investors. Also, I appreciate how transparent he is about any incentives he has related to his podcast or newsletter. I recommend signing up for the weekly email. Thank you, Jesse." Well, thank you, BAB3546. I'd be happy to send you a Super Soft Podcast t-shirt. Just shoot me an email to jesse@bestinterest.blog with your shirt size and address, and I will get that t-shirt mailed off to you. And before Cullen joins us today, I wanted to share a couple thoughts about the intellectual side of investing in portfolio management. I think there's a funny conundrum that I found in the world of personal investing. Usually investors who overthink what it takes to build a portfolio, they usually end up underperforming in some way, or at the very least, they find that all that effort earned them essentially zero marginal gain. It was just wasted effort. And then again, investors who don't think at all about investing can actually, do reasonably well, I would argue, but also they tend to float through the investing world with these really big misconceptions. And at times, those misconceptions can cause them massive damage. Personally, I think there's a Goldilocks zone, though. I do think there's a Goldilocks zone. I think it's important to learn about investing and to keep learning about it. And you don't have to spend every moment thinking about it. You don't have to update your spreadsheets on a daily basis and rebalance on a weekly basis. But I think there are lessons, these eternal lessons that you can build upon and keep learning about. I've built one upon the other, and it's provided me with this, I'm going to use the word steelier, right? This steely reserve against the slings and arrow that the market can throw my way. So we're not necessarily reinventing the wheel here with our investing thoughts or with being intellectual about the investing pursuit, but we are building up this framework of really solid ideas. And even if it doesn't make our investing complex, I still think learning more and more about it can only help us out. So first, I'm going to read to you guys from an article today that I titled Buffett's Way versus Index Funds, and it was inspired by a reader question. This reader wrote in and said, "Jesse, I appreciate everything you have to say on stock investing and low-cost diversified index funds. I also love all the Warren Buffett wisdom you share, but at least when it comes to investing, isn't Buffett a counter-example to diversified indexing? How do we square that circle?" An amazing question. And it's an amazing question. And I kind of think of this question. It's like that young, eager dad walking up, placing a baseball, sitting on top of a tee. So that little Timmy, that's me. I can step up with my $29 Walmart aluminum bat and hit a double out to left center field. Bam. So thank you for that very nice setup. But this reader has a great point, because the long-term investing, the long-term kind of passively based, low-cost, diversified investing that we talk about here on the podcast, that I write about on the Best Interest blog, that is not how Warren Buffett has invested over his long career. And I would actually argue that the last 10 or 15 years of financial media has basically misrepresented Warren Buffett's investment approach. I can go into that story a little bit, but basically it has started to say, and you will often find things that say things like, Warren Buffett has all his money in an S&P 500 index fund. That's not exactly true. But if you follow me today, you'll see that there is a lot of common ground between Warren Buffett's investment approach and the kind of stuff we talk about here. You'll also see where the divergences exist and why they exist. And I'll present maybe some sort of unified theory of stock investing that connects diversified indexed investing with some sort of more individualized stock picking and business picking. And it unifies them with some same core logic. So anyway, let's talk about a couple of the core commonalities up front. Whether picking individual stocks or buying an index fund, investors ultimately buy ownership in real businesses. That's what we're doing here, right? Stocks are not lottery tickets. They are shares of companies. They are fractional ownership of those companies, of their current earnings, of their future cash flows, of all their assets. That's what you are buying when you're buying a stock. And both Buffett-style investing and indexing rely on the idea that a company is worth the present value of its future cash flows. I'll say that again. A company is worth the present value, the value today, of all of its future cash flows. If we added up all the company's profits from now until Judgment Day, as Warren Buffett would say, and then we discounted those dollars back to today, that's what a business's intrinsic value is worth. But does a stock's price always match that stock's value or the company's value as we just described it 30 seconds ago? Well, that's where some of today's contention and confusion exists. I'd answer that question this way. I'd say that investors vote with their dollars. They'll buy or sell a stock if they perceive it as undervalued or overvalued. And on average, over time, yes, we expect a stock's price to be somewhat correlated with the company's value, right? That's clearly the expectation. You wouldn't expect a stock's price to always be wildly different and uncorrelated to the value of the company itself. But there are periods of time when a stock price is disjointed from its underlying value. This is especially recognizable in retrospect, right? It's very, very hard to recognize it in the moment. It can be very hard to recognize it with any sort of foresight, but given enough time in retrospect, that's when you can start to see it. This idea called the efficient market hypothesis, or EMH, the efficient market hypothesis, is the idea that all the buyers and all the sellers and all the traders in the stock market, they use all available information as best as they can to hone in on the proper price for a given stock. Now, it doesn't mean that today's price is guaranteed to be correct or perfect per se, but instead it suggests that poor schmucks like me, and I'd argue like you, can't possibly know enough to know whether the market is right or wrong. Or put another way, the market, all those buyers and sellers and traders, the market has all the information about any given company, while you and I only have some of that information. Over time, there's no way that you and I can consistently outsmart the market or consistently beat the market's prices or just be more accurate than the assessments that the market is bringing to us. That idea, that is the pillar of index investing. You can't beat the market, so why bother trying? Just buy everything at the market's given prices and then hold on for the long run. Now, let's pivot and talk about more specifically how Warren Buffett invests his money, or how he has always invested his money. Because the efficient market hypothesis is just one example of where Warren Buffett and his famous business partner, Charlie Munger, would very much disagree. They don't need to outsmart the market all the time. And they're not sure that they could outsmart the market all the time for what it's worth. But what they do argue is that they need to outsmart the market sometimes. They'd also say that they don't need to make really smart decisions about every single stock, but instead they should make very few investment decisions. But when they do make those decisions, they are smarter than the market. And sometimes they suggest that the stock market loses its mind, basically. There's some sort of temporary insanity, some sort of irrational exuberance or some sort of panic. It could be widespread. It could be relatively narrow. Maybe most of the market is behaving efficiently, but this small corner over here is acting kind of berserk. But either way, Warren Buffett would say that there are times when the market is not efficient, is certainly not accurate in its pricing, does not give appropriate prices to particular stocks. And earlier, I mentioned, the poor schmucks like me and you not having enough info to know whether the market was right or wrong on any given day. Well, Warren Buffett would say, I'm different than that. I do have enough info at times to know whether the market is right or wrong about a particular stock. And when Warren Buffett identifies one of those opportunities, and if that opportunity has a sufficient margin for error around it, just in case his math ends up a little too optimistic, well, that's when he pounces. And that's the method by which Warren Buffett has built his investing legend. Now, I really like this story. When faced with the idea that an investor could skillfully pick individual stocks like Warren Buffett did, and I will say, for those who really want to know, Warren Buffett did a lot less stock picking than he did of buying individual private companies, almost maybe like a private equity company would nowadays. Yes, he did some stock picking, but a lot of his empire involved, buying the Nebraska Furniture Mart, for example. It was a private furniture company in Nebraska, wildly successful business that Warren bought for a pretty reasonable price, and now he's owned it for 40 years or something like that. Or See's Candies is another one. If you're out on the West Coast, you know See's Candies. I think Warren Buffett bought it in the 70s, I want to say. And it's just been this wildly successful investment that he bought an entire private candy company. And he's owned that for the last 50 years. So anyway, that's how most of Buffett's success has been buying individual businesses. But yeah, he's picked some stocks too. Anyway, back to what I was saying before. When faced with the idea that an investor could skillfully pick individual stocks, the hardline index fund investor, the efficient market acolyte, would invoke the famous coin flipping metaphor. And in fact, there's a famous debate where a business school professor, it was 1984 at Columbia University, and a University of Rochester, my alma mater, a University of Rochester finance professor named Michael Jensen challenged Buffett's investing record. And Jensen said, if a large group of monkeys flipped coins and predicted if the coins would land heads or tails, over time, a small number of those monkeys would, by random chance or luck, correctly predict the outcome of a lengthy series of flips. And in essence, that metaphor is saying that Buffett's record, his stock picking record, his investing record, is nothing more than Warren Buffett being the one lucky monkey, right? It's just a lucky series of flips. But Buffett, in his Midwestern folksy way, he took that metaphor and ran with it. What if, he postulated, you follow Jensen's monkey metaphor and you get down to the best coin flipping chimpanzees in the world, only to find out that all of the best coin flipping chimps were raised in the same zoo? Well, it would beg the question, how could coin flipping be pure luck if all the best coin flipping chimps are from the same zoo? Surely there must be something in the water at that zoo. There must be some sort of special training from the zookeeper. There must be some non-luck, skill-based reason connecting all these winning chimpanzees. Buffett then laid out 9 individual investors who not only beat the market, but crushed the market for multi-decade periods between the late 1950s and the early 1980s. They weren't 9 random or cherry-picked investors. Instead, all 9 investors were students of Benjamin Graham and David Dodd, the 2 founding fathers of value investing. Ben Graham famously wrote The Intelligent Investor. He was Warren Buffett's kind of mentor and idol when Buffett was in grad school. But anyway, those 9 investors were all quote unquote raised in the same zoo, right? That is, they all followed very similar value investing philosophies, all from Graham and Dodd. And clearly, Buffett would argue, there must be some skill in their common investing approach. And that parable came to be known as the super investors of Graham and Doddsville. But there are some important caveats here too. Buffett does recognize that many people can't or won't invest the way he does. So he's on the record recommending index funds to most investors. And that's where that story comes from, where he has instructed that 90% of his estate be invested in an S&P 500 index fund for his heirs and for, charitable giving in the future. So basically what he's saying there is, I can be smarter than an index fund, right? Buffett can be smarter than an index fund, but he recognizes that not everybody can be. I think that's kind of a fair assessment. Also, another caveat, Buffett started investing in an era with basically no computer power, way less instant data, far fewer active investors looking for opportunities. The market was less efficient when he started investing. I think that's hard to argue with. But the real question for you listening at home is, can you follow that same path? It's not that the market is infallible. All you have to do is look at daily price movements to realize that the market is constantly wrong, but it is rapid to amend its previous mistakes. If it was perfect, why are the prices moving so much? How can it be off by multiple percentage points in a given day? The bigger question is whether you possess the insight and the information to recognize the market's mistakes, whether you have the patience to wait for the big mistakes, and whether you have the fortitude to pounce on those mistakes when you recognize them. Do you want to invest that way? Most people don't. In fact, the data is clear that even most professionals who attempt to consistently outperform the market will fail to do so. It's really hard to do. Instead, most people should accept the returns of their diversified portfolio, build a financial plan around those returns, and then just move on. In other words, the efficient market hypothesis is probably wrong, or at least it has some clear flaws, but 99% of people should act as if it's perfectly right. Here's a quick ad, and then we'll get back to the show. Did you know my written blog, The Best Interest, was nominated for 2022 Personal Finance Blog of the Year, and it's been highlighted in the Wall Street Journal, Yahoo Finance, and on CNBC? I love writing, especially when that writing is to share financial education, and I usually write 1 or 2 articles per week. You can read them all at bestinterest.blog. Again, the web address is bestinterest.blog.
Check it out.
And with that, let's bring Cullen Roche onto the show. Cullen is the founder and chief investment officer of Disciplined Funds. And through his writing and research, he brings this rigor and nuance and real-world perspective to topics that are often either overly simplified or completely misunderstood. And Cullen recently published a book called Your Perfect Portfolio, which explores over 20 different investment strategies in a quest to find the best way for you to invest. All right, Cullen, thanks for stopping by the podcast, man. And let's start with this cool term that I've kind of previewed for the audience a little bit. You call it defined duration. And just reading some of your research, it's almost like taking some sort of almost fixed income concepts of duration and applying it to stocks in order to maybe level the playing field when it comes to building the portfolio. But I thought if you could, maybe you can start with just reminding the audience what duration really means, especially kind of from a fixed income world. But then could you pivot and explain this term you use, the point of indifference, and how to apply the concept of duration to stocks?
In the fixed income world, the concept of duration basically means interest rate risk. It's really, you're trying to apply a time horizon over which the instrument has principal risk. And so you can actually understand that, for instance, a bond with a duration of 5 basically means that if the interest rate relative to that fixed income instrument moves by 1% in either direction, the duration being 5 means the principal will change by 5%. So if interest rates go up by 1%, the bond's principal value will fall by 5% inside of that period, inside of like a 1-year period. And so you have this very strict understanding of the way the principal is related to the time horizon over which the instrument might have a certain sequence of returns risk. And that's really the kicker, is that you can think of bonds in terms of a sequence of return risk outcome, where when something bad happens, you kind of know mathematically, well, what is my break-even point in the long run? How long is it going to take me for the interest that this bond is paying for me to get back to my break-even point? And so you have this very quantifiable concept of risk across certain time horizons when you understand things like duration inside of bonds. And in the stock market, we don't really know how to apply that. Nobody even really applies time horizons at all to the stock market in a quantifiable way. And so when I talk about defined duration, I'm kind of trying to extend the idea of bond duration to all instruments. And so when I'm defining the duration of the stock market, for instance, what I'm basically doing is we're taking an assumed max drawdown and an expected future real return, and we're trying to sort of estimate what is a reasonable time horizon over which this instrument might generate a real return, a real break even. And that's what William Bernstein has called it's your point of indifference. It's where you become indifferent to the principal change of the instrument in real terms. And so this is basically a quantified way of applying the same principle, where you're applying a sequence of returns to the instrument. So for instance, if the stock market fell like 50% and you had a certain expected real return, you could quantify what is the time horizon over which that instrument would generate a real return where you kind of break even. And the historical defined duration of the global stock market has typically come out to like 15 to 20 years. And so if you apply this sort of a reasonable max drawdown, something like a 50% drawdown, and then an expected average annual return, the real return break-even point is about 15 to 20 years on average, applying that sort of a methodology. And so this allows you to start to apply a time horizon to the stock market, in essence. You're applying a sequence of returns risk expectation to the stock market, because this is what especially retirees, it's what every retiree worries about is, am I going to retire into 2008? The stock market falls 50%. I'm undergoing a 4% withdrawal rate, which suddenly turns into an 8 to 10% withdrawal rate when my portfolio gets cut in half or something like that. It's every investor's worst nightmare. And when you can start to quantify this out, what it allows you to do is it allows you to start doing what's called more of an asset liability matching methodology, where, just for background, I worked with banks after the financial crisis because I did a lot of wonky sort of macroeconomic analysis on quantitative easing and what was the impact of interest rates and whatnot on on bank balance sheets and bond portfolios primarily. And I realized working with banks that all my retail investors that I work with have the same problem, the same temporal mismatch, because banks borrow short and they lend long. They have an asset liability mismatch in their and they have to be very, very conservative about how much that mismatch is actually differentiated, because if you're not careful about it, you end up like Silicon Valley Bank.
Silicon Valley, sure.
But the funny thing is that retail investors have the exact same issue. I realized when a retail investor sells into a bear market, what's really happening psychologically is they're selling stocks, they're selling a long duration instrument because they want the certainty of a short duration instrument. They're buying cash, selling stock because they're realizing that, hey, they don't have enough certainty in their portfolio. They don't have enough safe assets to give them the certainty to ride out the volatility of the stock market. And so when you can begin to then build in sort of an asset liability matching process to a retail investor's investing methodology, you can start to build what is basically like it's kind of like a bucketing strategy or like a structured ladder portfolio, but you're embedding the stock market into all of this now where, for instance, you can build out let's say a 0 to 10 year bond ladder that is pure fixed income, and you just have this rolling ladder. And then if you're able to quantify the defined duration of the stock market, you can actually start layering other assets in where you can sort of quantify the sequence of returns out to like 30 or 40 years in theory. So, and then you can start thinking about everything and reframing everything in time horizons rather than the way we currently do asset management for the most part is basically like, okay, here's a diversified portfolio of, let's say, 60-40 stocks and bonds, and I've run your retirement analysis through 10 million Monte Carlo simulations, and you have a 99% odds of success in not running out of money. And that's great. It's a good process, but it doesn't give people an understanding of what they really want, which is, when am I going to have money at certain times in my life? Am I going to have $50,000 to buy a car in 2 years? Am I going to have $150,000 to send my 4-year-old to college in 15 years? Am I going to have $2 million in 20 years when I'm 65? And that's what people want to know. And when you can start to sort of reframe everything in time horizons and then quantify it, there's guesswork that goes into all of this, obviously, because you're guessing, you're assuming the max drawdowns, you're assuming expected future returns, but you're beginning to quantify this in a way where it becomes much more rigorously sort of attached to a quantifiable process rather than the guesswork that goes into just saying, here's a diversified portfolio, I understand your risk profile to some degree, and we're pretty sure that you're going to have enough money, but we're not really sure if you're going to have the money in certain buckets when you really need it.
It's just a fantastically deep answer, but let me play devil's advocate on behalf of some listeners, because I skew maybe a little more conservative than some of my listeners, and they give me some grief. And some of the numbers, when you just mentioned that 15 to 20 year duration for stocks, I bet you perked up a few ears. So quite a number of listeners, maybe they come from the FIRE background, maybe they're bogleheads. They've seen some data that says like, well, in 2/3 of years, stocks outperform bonds, or maybe in 2/3 of years, stocks have a positive nominal return. So that's one baseline. Another way of thinking about it is if I look at all 5-year periods over stock market history, stocks are positive 88% of the time. If I look at all 10-year periods, stocks are positive 93% of the time. I know those numbers might not be precise, but the point is that I would wager a lot of people, if you just describe asset liability matching to them, which is a terrific topic, I've brought it up a couple times before. Even I, sometimes when I'm describing it, say, yeah, once you're 8, 10, 12 years out, time to start sprinkling in stocks. When you said that 15 to 20 year duration, does that mean that typically when you might be doing a financial plan, you're going to wait until year 15 before sprinkling in stocks? Or what exactly does that look like? And maybe also, where does that 15 to 20 year number, where does that actually come from?
Yeah, so you're actually running the math on it's basically just assume a max drawdown and then assume an expected real return. And you can then quantify what is the defined duration based on the math there. So that's where the actual figure comes from. And I'm extrapolating this from, for instance, in the current environment, it's kind of a nice time to to be articulating this because there's this really big disparity in valuations, for instance, across the tech world. Even the domestic United States has a huge disparity in valuations, but the global stock market, especially where U.S. CAPE ratios are like 40 and foreign markets for the most part are something like the low 20s. And this is it's a gigantic, unheard of sort of disparity. And when you extrapolate that out, one of the things that we know is that the expected future risk-adjusted returns of stocks they're pretty highly correlated to CAPE ratios, because CAPE ratios reflect basically expectations. When expectations are really high, stocks tend to generate not necessarily lower returns. I think this is the mistake some people make. It's not that stocks necessarily have to generate lower returns. It's that they're likely to generate more volatile returns, meaning that your sequence risk is higher. So if you bought the very tippy top of the NASDAQ bubble back in 2001, you generated an 8% return since then. But you had to go through, 15 years of absolute trauma to even break even in real terms. And so you went through not necessarily a lower return, but you went through a much more volatile period of returns. And so that's part of what we're trying to extrapolate out here. And so I think what we're doing to some degree is we're trying to communicate the potential risks here. And that 15 to 20 year number, what it does is it gives you kind of a baseline for understanding, what is a reasonable time horizon over which to judge the stock market? We say things like, stocks for the long run or, whatever it might be. But rarely is that number ever quantified or put into some sort of context. You're framing it nicely in terms of like the probability of certain outcomes over certain periods. And yeah, you're right. When the stock market, over rolling 5, 10, and 20-year periods, the stock returns are something like 88 to 95 to 99% positive. But what that 15 to 20-year number does is it gives you a baseline number for understanding where the stock market fits into a portfolio. And then you can start to blend things. And that's where this whole process gets kind of cool, for me at least, is that you can start blending instruments. You create multi-asset instruments inside of a portfolio where, for instance, a 60-40 portfolio right now has roughly like a 14-year, this is a global 60-40, has roughly like a 14-year defined duration. So, and if you did something that was like an 85-15 bond stock portfolio, that might have more of like a 5-year defined duration. And so when you blend things, you can start building multi-asset instruments or embedding time horizons into the portfolio methodology where you can communicate to somebody that, hey, in my Roth IRA, which I'm not going to touch for 40 years, I'm loaded to the gills with AI stocks, technology. I'm actually loaded to the gills with VTI or like the absolute riskiest stuff in a portfolio that you could possibly have, because I know that the time horizon of that is extraordinarily long. I don't have to worry about the sequence of returns risk. Whereas, if someone's got a taxable account where, let's say they're drawing it down every month and they're living off of the portfolio, they need a lot more certainty in there. You probably need something that has an average defined duration in there that is much shorter on average, because you're probably front loading it with, who knows, like treasury bill ladders or CDs or something like that. It's much more front loaded, so you've got liquidity in there. You can start to build this out in a way where you're communicating the time horizons over which all of this is serving very specific financial purposes. And so that's kind of the goal of trying to quantify this to some degree, is to communicate it better to the client so that they can kind of compartmentalize things and see and understand, okay, I know the role of the T-bills in my portfolio. And this is the other kicker, is that it actually gets you away from performance chasing, because when you look at it through the lens of the time horizons, you sort of know, well, I don't care that my T-bills are going to underperform. Of course they are. My taxable account that's loaded to the gills with short duration stuff, it's going to underperform the S&P 500. I know that. It's designed to do that. Whereas, maybe my Roth IRA that's loaded to the gills with technology and, growth stuff, that's where you can get sort of the sexy high performance from a portfolio. But you segment things in a way where it's communicated very clearly that, hey, each bucket or each portfolio is sort of serving a very specific role as it pertains to my financial plan.
I think if I can summarize part of your answer, it's that the defined duration of 100% global stocks, that's 15 to 20 years. But the defined duration of 30% stocks, 70% treasuries, well, that might have a defined duration of 8 years. So if I'm matching that future liability in 2035 of my retirement, 8 or 9 years from now, to a particular asset, maybe that, what did I just say, 30% stocks, 70% bonds, maybe that's the right asset to match to that future liability. And so in that way, as I'm building my asset liability ladder, stocks do enter the picture before year 15. It's just in a muted way.
It's not dissimilar to what target date funds do to some degree, where a target date fund, a 2060, it was funny actually, somebody asked me this, they sent me an email the other day about one of Vanguard's 2060 target date funds, and it's like 90-10 stocks, bonds. And I thought about that through the lens of a defined duration process, and I said, gosh, that thing's got a 35-year time horizon. That 10% bonds are serving zero purpose. That portfolio should be probably 100% equities. It might even need to be, there's an argument that it could be just growth stocks and higher growth stuff, because its defined duration would be so long. But target date funds are a good sort of corollary to this, because what I'm really trying to do is I'm almost trying to break down target date funds into components where you can now take the same sort of concept of a target date fund, but apply it to your portfolio in a way where, okay, I have a target date fund for the car purchase that I'm making in 2 years. I have a target date fund for my daughter's college in 15 years. I have a target date fund I'm applying to, my retirement in 30 years or whatever. And you can customize this and blend it, though, in ways where the portfolio is very temporally weighted in this more structured manner.
Here's a quick ad, and then we'll get back to the show. I send a free weekly email to thousands of readers that shares 2 simple things, just 2. The first are my new articles and podcasts, so you'll never miss when I publish new content. And the second is my favorite financial content from other corners of the internet, so you can see what's been helping me the most.
But Jesse, I don't want another email.
I hear you. I make this newsletter short, sweet, and full of essential information, and readers enjoy that. About 85% of newsletter subscribers are engaging with the newsletter more than once a month. They're enjoying it, and you will too. You can subscribe for free on the homepage at bestinterest.blog, and you'll get a free PDF of my white paper titled The Step-by-Step Guide to Building Your Retirement Paycheck. That's right, a free weekly email that thousands of people like you are already reading, a free white paper to help you plan for retirement, and you can sign up for free at bestinterest.blog. One thing you said multiple times, Cullen, is real returns, right? Everything you're talking about today is real returns, inflation-adjusted returns, which brings up inflation risk. So for our audience of kind of DIYers, retirees, people thinking about retirement largely on their own, inflation risk is definitely a scary one. How do you tend to incorporate inflation risk into, I'd say, your research writ large and your financial planning thoughts writ large?
Yeah. I mean, it's hard because you have to predict inflation in a financial plan. Anytime anyone goes through financial planning software, we all have to sort of embed, an assumption about what is the future inflation rate going to be. So, this sort of macroeconomic analysis comes into all of this to some degree. Don't want to get too deep in the weeds about how to do that, or, a very simple way is sort of what's called an extrapolative expectations process, where you're basically just extrapolating the past into the future. That probably comes out to 3.5%, something like that. That's not a bad approach. I think that going forward, I've made arguments that the probability of kind of returning to a pre-COVID type of inflation environment is relatively high, just because I think that the 2 big trends that are going on presently, basically the demographic trends where the United States we're not producing as many people and the population itself is getting older. That's a recipe for kind of lower demand. And that's been something that's kind of been in progress for basically 40 years. But the other big one is technology. Technology, and especially AI, once the robots really come online and they start to really ramp up production of everything, because the robots will never stop working. They'll never stop making stuff. We really are in a world of abundance there, where you get this potentially lower rate of inflation because the supply problem is just solved across so many different sectors of the economy. But that creates a paradox also, where inequality is probably much higher, and you probably have more demand for something like a universal basic income. Government fiscal policy is probably much more important, much larger in that sort of a world. and you potentially get inflation from that. So I wrote in a recent sort of blog post, the 2026 Financial Planners Outlook, that something in that 3 to 3.5% range is probably pretty reasonable, because even if we get a return to like 2.5% inflation, you should expect sort of COVID-like shocks along the way. And that could come from a recession in which the Fed and the Treasury respond with big time stimulus, and you get these sort of a bumpy sort of inflation where you get maybe not a COVID, style jump in inflation, but you get a response mechanism that results in, say, a shock of 4 to 5% temporary inflation that then, those big tailwinds, or those big inflation headwinds that I talked about before, they ultimately operate like a magnet. They suck the inflation rate back down because they're just huge secular headwinds to inflation in the long run, that they're gonna continue to sort of pull the inflation rate back down to, say 2 to 3%. But I think that's a pretty reasonable expectation, but it's something that we all have to estimate, and it's a hugely important part of the equation. I think it's typically better to be a little more conservative about the estimate. So even if the Fed has a 2% target or something, or let's say that inflation over the last 15 years has averaged like 2.5%, I still think it's reasonable to sort of err on the more cautious side. And so that's just typically how I operate as an advisor anyways. Like part of why I use a 50% max drawdown in the defined duration concept, because I'm assuming almost like a sort of a worst case scenario, or a realistic large drawdown. That's not uncommon, especially in real terms. And so it's sort of plan for the worst and hope for the best approach. And if you cover those bases, then, you really do have a much higher probability of actually understanding what are the likely outcomes across even, the worst sort of scary types of environments.
You mentioned fiscal stimulus in there. You said, it's possible that inflation might rear its head if there's a recessionary shock and the government responds with a big injection of fiscal stimulus. This doesn't come up every day, but I think there's a pretty good subsegment of maybe the American populace and retirees too, who look at government stimulus. They might not know what the modern monetary system is, but that's kind of part of it. They worry about fiscal policy. They worry about increasing levels of government debt and how that might affect long-term market outcomes, long-term inflation, and therefore how those things might affect their retirements. What are your thoughts, again, kind of from some of your macro research, from some of this long-term research you do? I mean, should retirees be concerned about those things?
Gosh, I mean, I field a ton of questions about, like, is Social Security going to be a thing, in 5 years? I have people who worry it's going to go away tomorrow. It's weird from a sort of understanding the principles of the monetary system. I think a lot of people think of the government as something that is going to run out of money, which is also, it's a weird narrative because most people also understand that the government has a printing press. And so the whole idea of the government running out of money is sort of nonsensical. It's the thing that makes the government unique is that they don't run out of a line of credit. They can run into an inflation problem where they're creating so much money that the demand is functionally falling for that money because they're just creating so much more of it that the amount of money relative to the supply of goods and services out there is shrinking. And that results in higher consumer prices, for instance. But the government doesn't run out of money. And so the capacity for us to afford things like Social Security or Medicare is theoretically infinite. It's just it's a balancing act especially for the United States. We're such a productive economy that's the thing that really matters. Is it's how much are we producing relative to the amount of money we're also creating. And so it's a balancing act for the government to balance that out. But it's a big part of why we haven't had high inflation in the United States over the last 40 years is because we are the wealthiest, most productive economy in all of human history, basically. And so that's another sort of big headwind to high inflation ever taking off, is that part of that assumption that we're going to encounter something like a return to the 1970s or a huge high inflation rate, a hyperinflation sort of event, is that most Americans are going to wake up and suddenly start being like, I don't like making money. I don't like making stuff. I don't want to be rich. I don't want to be productive, which is just, there's something in our DNA that sort of seems antithetical to that. for better or worse. I don't know if that's even necessarily a good thing, but it's certainly a good thing in terms of being able to produce lots of stuff. And being able to produce lots of stuff means that it's very hard to produce very high inflation because the government just can't create enough money. And so it's an important thing to understand, I think, especially. I don't like to get too sort of deep in the weeds about monetary dynamics especially with clients and people like that, because it can be counterproductive to a large degree, because it's just it's not something that I think most people really need to worry about. It's worthwhile understanding the dynamics so you're comfortable with it, so that you feel comfortable enough to sort of, like I field this question with bonds a lot, like are interest rates going to surge because, the government is going to run out of money, and then all the credit instruments are going to go to zero or something. And it's like, well, no, that's not functionally possible. So, that you could have a high inflation in which the Fed has to reset interest rates and stuff, and that will obviously have a big impact on the bond market. But that's a totally different dynamic than a company running out of money and experiencing a credit event. So it's a very different dynamic, and it's important to understand that stuff, but you don't want to get too deep in the weeds on that, because then you get into the Zimbabwe rabbit hole that becomes sort of counterproductive.
No, it is funny. I think there's a totally understandable kind of human psychology trap, which is, we take the rules and regulations that apply to us as individuals, and we try to apply those rules and regulations to other circumstances in life, thinking that there's a parallel. Unfortunately, the rule that as an individual, you probably shouldn't spend more than you earn, and you certainly shouldn't spend more than you earn for a really, really long time and go further and further into debt. It's a great rule in personal finance, but it very much legitimately does not apply to the way that the U.S. government works. As weird as that is to think about.
Well, that's weird too, because the government should try to nudge us to be productive, and they should incentivize us to do things that are productive in the long run and whatnot. But at the same time, the government is a weird instrument or a weird entity, because they're, in a lot of ways, they're like a nonprofit. They don't have to generate a profit, but in a lot of ways, they have to actually do a lot of the things that capitalists don't want to do, or the things that capitalists actually are not very good at making money at or can't make money at. For instance, like running a military, building things that you're going to destroy, like armaments or bombs or whatever, and then having a workforce that you might literally see get killed is a really bad way to run a business. And so, running a military is obviously not a profitable endeavor from the government perspective. And it's not designed to be, so the government, to some degree, not just in terms of running the military, but also running like a safety net and, trying to take care of some of the people who can't take care of themselves in society and whatnot. Those are functions that are not going to be profitable. And so for the rest of us out there, there is a certain degree of sort of like loss acceptance involved in that we're going to say, okay, well, maybe we accept a lowish rate of inflation, understanding that, well, every retiree is getting Social Security, and that's a good thing. Or, we have a military that can defend us, and that's a good thing, even if there's an inflation impact from the costs that are incurred along the way.
Well, I know we've kind of gotten into a couple more complex subjects there, Cullen, but one thing I think about is how to find that balance between, yes, understanding the complex things, and in some cases, tackling the complex things inside our financial plans, inside our retirement plans, but still balancing enough simplicity so that we can actually function within our retirement plan. Or, I think about, how does a DIY investor, for example, balance simplicity of like indexing with some sort of tactical risk management, not necessarily chasing returns? Like, how much juice is worth the squeeze in terms of this financial planning exercise that we're doing? So I'm just curious, because like I said, you get into some really interesting complex topics, but then you distill it down into some pretty simple outcomes and pretty simple takeaways. So I'm looking for any tips or tricks that our listeners can walk away with today of how to find that balance.
It's hard. Christine Benz from Morningstar wrote a great article, it was about a month ago, I think, about optimizers versus what she calls satisficers. And, and it's that balancing act between, trying to optimize and tinker with every aspect of your portfolio versus just defaulting to something really, really simple. And it's hard. Everyone's different. That's the thing that is really important to understand about, especially portfolio management. I actually am in New York right now in a hotel room because I'm promoting a book called Your Perfect Portfolio. And the whole gist of the book is basically that your portfolio needs to be perfect for you. It can't be what somebody else is selling. Don't listen to the guy talking about defined duration and be like, oh, I need to buy that because he seems smart, or he, seems smart enough, and, seems like a good strategy. Or I read this risk parity strategy from Ray Dalio. He runs the biggest hedge fund in the world. I got to buy that one. You got to find what works for you. And that is very much like the analogy I use in the book is it's very much like finding a spouse in life. You have to find someone who works for you, and you have to understand that there's going to be ups and downs, and you have to stay loyal and committed. I interviewed William Bernstein in the book, and he wrote about how the suboptimal portfolio that you can stick with is going to be better than the theoretical optimal portfolio that you can't stick with. And he's trying to communicate that you might have this theoretically optimal portfolio where you've back tested it, you looked at all the numbers on it, and that thing whipsaws you once and you say, I can't do this. So you sell it into a bear market. And when you do that, that theoretically optimal portfolio is serving you worse than something that, if you'd just gone out and bought like a 60-40 portfolio. Or, I also interviewed Taylor Larimore, who came up with the Boglehead 3 fund portfolio in the book. And that's like the simplest portfolio that exists out there. But it's a balancing act too, because like I wrote in the book that the Boglehead 3 fund portfolio is brilliant in so many ways, but arguably the biggest flaw in it is that it might be too simple because it's basically just two buckets. It's, inside of my framework, I would say, well, he's really only constructed two time horizons. And so what happens in a 2022 when both of those buckets go down a lot? And does that scare you? I think for a lot of people it does. Or does it make you question it to a point where you say, you know what? I only own stocks and bonds. I don't even have a lot of temporal diversification in here. I kind of wish I had bought gold, or I wish I had bought, managed futures, or something that was truly uncorrelated. And so it's a process that everybody has to go through for themselves and sort of understand the risks and the different ways that all these instruments and strategies work. And you have to find something that works for you. And that's part of also being a decent financial advisor, is that you can help people sort of understand how to do that. And you can, most importantly, even if the process is imperfect, which is, it's always going to appear imperfect at some times. In fact, that's part of the benefit of diversification, is that Brian Portnoy says that diversification is learning to hate some part of your portfolio all the time. And weirdly, that's exactly right, because when everything's operating the exact same way, it probably means that when things go haywire, they're going to be operating all the same way. And that means you're not diversified enough. And so learning to hate some part of your portfolio that is down is weirdly sort of a good thing, because it means that your portfolio is operating the way that it should be in a diversified strategy. And so, but at the same time, everyone has to find, the right balance of that. And, you have to mix in things like taxes and fees, and it can get very, very complex very, very quickly. So I don't know if I would describe myself as an optimizer or a satisficer. I think I'm kind of in the middle to some degree, where I've tried to sort of distill a strategy that can be very, very simple, but is still optimized to a specific financial plan. But that's just me. There's a lot of people who will hear terms like defined duration and sequence of returns and be like, oh, okay, this is just nonsense jargon. And I need something. That Boglehead 3 fund portfolio sounds really nice to me. And if you could stick with it, I mean, that's great. That's the whole Bill Bernstein thing, is if you build something that's simple, low cost, tax efficient, and you can stick with it through thick and thin, that's really hard to beat.
That's awesome. So it sounds like on the spectrum of optimizing to satisficing, you have found an asset mix that is perfect for you, Cullen. And that's the name of the game. You have found your perfect portfolio.
Yeah. Perfect for me. Yeah.
Perfect for you. If listeners are curious and they want to, you're a prolific writer. You've mentioned your blog. I've read your white papers, and now with this book. Let's talk about the book, because in case listeners want to pick up a copy, but then also if people just want to start following your work more closely, where can people find you?
So the book is called Your Perfect Portfolio, and the book I wrote 10 years ago, Pragmatic Capitalism, is sort of wonky and macroeconomics, and frankly, I was reading parts of it, I was like, man, this book is terrible. Just boring. But this one's a lot more fun, and it's it's explorative. I write about some principles of portfolio construction, and then I write very specifically about 20 or so different strategies. And, they range from very simple to much more complex, but for the most part, it's all very approachable. And I wrote it in, I'm a dad now. That was the biggest difference between now and writing my first book. And so I write lots of terrible dad jokes in there. So I tried to be a little more playful. I try to not dumb it down, but I try to write it in a very approachable and understandable way. But also I write a sort of blogging newsletter called Discipline Alerts from the Discipline Fund's website. And sometimes they're more wonky. Sometimes they're just sort of weekend thoughts, kind of my ruminations about what's going on in the world, why tariffs are good or bad, or why, the debt ceiling is another nonsense, conversation that we're having once every 3 months or so. And this is why it's a nonsense conversation. And so I get into a little bit of politics, a little bit of just, everyday life, and a lot of sort of, important investing concepts.
Well, we'll link to all those resources in the show notes, Cullen. And thank you so much, Cullen Roche, for joining us here on Personal Finance for Long-Term Investors.
Thanks, Jesse. Great talking to you.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.